December is historically an atrocious month for day traders across both the stock market, Forex markets, all markets as a matter of fact. And in this video, I'm going to explain why this actually happens. And then I'm going to give you 3 reasons why you should consider slowing down or completely stopping your Forex trading or your stock trading as we go into the end of the year and towards the holidays. So if you think about what a market actually is, right? A market is made up of buyers and sellers. And if you just look at what happens towards Thanksgiving and then really in towards the last couple weeks of December and the first week of January, as a matter of fact, what's happening is a lot of people are stepping away from the charts. People are going back home. They're spending time with family. They're going on vacations. And not only just individual retail traders like you and me that are doing this, but also hedge funds, banks, institutions. A lot of these big players that are active in these markets are actually stepping away as well. They're closing their books. Employees are off. They're not doing as many transactions. All this sort of stuff is happening. So because these big players and small players are out of the market, there's 3 things that happen which makes trading environments less profitable. No matter if you're a manual trader or if you're a trader that's using some sort of algorithm, historically across most trading systems, the results in December aren't as good as the rest of the year. So if you think about all these big players are out of the market. So what happens? Well, number 1 reason to consider to stop trading is because there's less players in the market. This means that the spreads are going to be higher. Okay. If you look at your broker towards the end of the year, the last couple weeks of December, the first week of January, you're going to see that the spreads are a lot higher. And this is something that directly eats into our profits as traders. And it's something that we don't really have any sort of control over. Granted, we don't have control over the markets either, but this is something that is going to automatically make your trading more difficult because there's less players in the market, there's less liquidity. Brokers have to naturally increase their spreads. So this is just one reason why you should consider not trading. The second reason why you should consider not trading or being very selective about your trading is if you look at it, there's a lot less volatility in these weeks towards the end of the year and the very beginning of the year. And really as traders, especially retail traders, what we need in order to survive is we need volatility. We need volume in the market. This makes the spread smaller. This allows for these bigger moves to happen. So the second reason is that there's a lot less volatility. The third reason to consider not trading is because these big players, they're not in the market. Generally, you're not going to see any sort of big moves. Generally, you're going to see, volume and volatility dying down. And so you won't see these big impulse moves, which is, retail traders. This is where we can make a lot of our money is by piggybacking on kind of these big guys that are creating the trends in the market. And so they're pretty much gone. So we don't see these big impulsive moves. And we also don't see these long drawn out trends generally in these weeks towards the holidays. So this is another reason to consider not trading. Now, one other thing that's happening, which I guess is a little bit more applicable to the stock market, is towards the end of the year, people are doing something called tax loss harvesting, where they're basically going out and they're selling their losing positions in order to realize a loss. So that way they decrease the amount of tax that they're actually going to have to pay. So generally in the stock market, you see, stocks starting to pull down towards these weeks in December. And then generally there's this thing called the Santa Claus effect, which is the last week of the year where essentially stocks start pumping again because people have sold off a lot of their losses and they're going in and they're rebuying positions in companies that are similar to the ones that they ended up selling off. So historically, the last week of the year, actually in the stock market, 75% of the time has had these large upswings in price. So to recap here, because a market's made up of buyers and sellers, and because there's less buyers and sellers in the market, this causes larger spreads, which is unfavorable for traders. This also causes less volatility, and this also causes less big moves, less impulse moves, less trending moves in the ending part of the year. So what do you do in the month of December if you're not going to be trading? One thing that you can do is to continue your education. And one of the best things that I could recommend if you're trading Forex is check out this video right here. It's 10 Forex tips to instantly work your way in towards the 1% of Forex traders. Most of these tips are actually proven by data. These are not ideas or theories. This is actually proven by data. So go ahead and check out that video right now.